Hi there. Welcome to The Open here on BNN Bloomberg. I'm Lindsay Biscaya in for Andrew Bell today. And now let's get to some of the stories we're following for you in the BNN Bloomberg newsroom. Shares of CAE are trading lower in the pre-market. That's after the flight training company posted total revenue for its latest quarter that came in below expectations. Revenue in its civil unit also fell nearly 5% and missed estimates. CAE says the segment experienced softer order activity than expected. On the upside, the company is boosting its 2026 outlook for defense. Air Canada posted higher than expected revenue and profit in the fourth quarter. The company saw stronger than expected demand across both cargo and passenger segments. The airline also reported growth in Atlantic and Pacific revenue, even as transborder travel to the U.S. declined. And Hydro One posted fourth quarter profit and revenue that beat estimates. The Canadian electrical utility says it has partnered with First Nations communities and secured the necessary funding to begin work on the Chatham to Lakeshore transmission line. The CEO says the project is the first to be developed under a 50-50 equity model, calling it a meaningful step toward reconciliation. And we'll take a look at the markets, the pre-markets this morning. U.S. futures are trading up at the moment after the latest CPI numbers came in the U.S. We'll, of course, be breaking that down for you in moments. And if we take a look at the TSX very quickly, it was down yesterday. Today, it appears to be flat at the moment, but potentially trading up. We'll have to wait and see what happens when markets open in about half an hour from now. And we're keeping an eye on the markets after January U.S. CPI report was released this morning alongside a wave of corporate earnings. So for more perspective on all of that, we're joined now by John Zechner, chairman and founder of J. Zechner Associates. It's good to have you join us this morning. Good morning.
Hey, good morning, Lindsay.
So let's start with those CPI numbers. Rose 2.4% year over year, slightly below estimates, maybe not exactly what the Federal Reserve wanted to see. What do you make of these numbers?
Yeah, you're right, Lindsay. The headline was maybe a tenth below. The core was right in line, and it's still sticky in this 2.5% range. You've got a lot of mixed economic data, so it's a hard read for the Fed. And I think the leading of the governors, you hear most of them talking, is really just to stay the course for now, because in the absence of knowing whether the economy is running too hot or too slow, they'll just they cut rates three-quarters of a point. I think they're happy to sort of leave it at that for now. And yeah, obviously you're going to get with Kevin Warsh coming in, he's going to try to tilt some members more in the direction of lower rates, but that's going to be a tough call when you listen to what they're saying. And the economic data is mixed. I mean, that employment report the other day, Lindsay, that really surprised me. I mean, it was stronger than expected, and that's after sort of a soft, ADP, soft challenger job numbers. JOLTS numbers were all a little weaker. I would have taken the under on that number and it sort of beat. Trump really wants to run this economy a little bit hotter, and I think he thinks that's going to help his chances in the midterms, and he wants to get the Fed on side to cutting rates to do that. So there's a lot of mixed economic signals. I don't think this changes anything for the Fed in the near term, and they'll just continue to watch how these numbers play out. For now, the economic data is surprisingly resilient.
That was going to be my next question, is whether this changes anything in terms of how many rate cuts, if any, you expect to see this year. Some analysts saying 2, some saying 3, but you think it doesn't really change much. Like, the number hasn't changed that much, really.
Oh, no, exactly. I've seen some saying, no rate cuts this year, because if you play the other side of the coin and they try to run the economy a little bit hot, because you've got the one big beautiful bill out there with the tax cuts, so that's stimulating some consumer spending. You still got this K-shaped economy, which sort of favors the higher end consumer, and they're still spending. You saw that in the airline numbers this morning and things like that. Whereas retail sales numbers, which the whole economy are softer, so it really is a mixed bag, but there's still, you got massive fiscal spending out there still. You're doing a over 6% deficit to GDP ratio, which is almost unheard of for like a non-war, non-recessionary time. So it's like it's pedal to the metal in terms of what they're trying to do to the economy. So in that environment, boy, it's hard to raise the argument, hey, we got to cut interest rates dramatically. But that's what the president is pushing for and what he wants. I think that's what the gold market is telling you. They're worried about that risk, and I think that's why long bonds are still in the U.S. still trade up around 5% because they believe that inflation and excessive growth is still as big a risk as weakness.
For sure. Okay, that's something to watch. But we're also watching a slew of earnings coming in this week once again. So I want to get your thoughts on a couple of them. We'll start with Cameco. So Cameco earnings beat estimates boosted by a lift in uranium. I'm wondering what you make of the numbers there and that report.
Yeah, the numbers were a bit of a beat, not on production and not from the Westinghouse side, which is the contracting for nuclear reactors, which is a good business that they added. It was really the price of uranium, which is stronger. My issue with Cameco, and when we've reduced the name, actually almost eliminated from the portfolios recently, just on valuation, trading at 35 times forward cash flow. If I was going to play it, I'm positive on uranium longer term. I'd rather do it a cheaper way, which play the Sprott Physical Uranium Trust, the U.T in Toronto, something like that, play it directly. So that helped. But clearly people love the story, and it is the go-to play on a global basis in uranium right now.
Mm-hmm. Another one, Agnico earnings. Agnico, this is really interesting to me because they topped Barrick now in one of the biggest gold output producers in the world. What do you make of the latest earnings report coming in from Agnico?
You know what's really interesting about those numbers, Lindsay? It's just the way you look at their all-in costs, and I mean, the cash costs are running around $1,100 an ounce. The all-in cost, around $1,500 an ounce, which is for years when gold was around 2,000. They're profitable companies, but not hugely profitable. Those costs stay the same, and suddenly you're looking at $4,000 or $5,000 for gold. That's why these stocks are soaring, because all of that money flows to the bottom line. They've got the production in place. They don't, that it doesn't cost them any more to maintain that production, so it's all free cash flow. They can start buying back stock, and that's why these stocks are going to soar. So it's going to be an interesting tale to tell going forward what these companies do with some of that excess cash. And clearly, if gold's prices stay around these levels, these guys are going to be just printing a ton of cash, and it's good for the stock. They could do more buybacks. Maybe there's more corporate activity. I don't know, but it certainly it illuminates how profitable the gold business, mining business is right now.
It does seem like so many of these gold mining companies just soaring on the high gold prices, obviously. You wonder how they'd be doing if gold prices weren't so hot at the moment.
Well, we've been up and down cycles with that. I've been doing this for 40 plus years, Lindsay. And I've seen these cycles where they all start to spend at the top and they buy each other. And they've shown a better discipline this time around. And I think that's why the stock prices are acting better, because they're not going out and sort of making the crazy acquisitions or even putting the money drilling into the ground, because those costs have gone up dramatically. I don't think anybody's brought a new mine into production on time and on budget in the past decade. So, it's better just roll out the production and improve, the cost structures, and just take this money and give it back to shareholders, higher dividends, share buybacks, whatever. Shareholders love it.
We're just going to fire through a couple more of these before we're out of time. CAE Industries also beat estimates in their third quarter. They're reporting that. What do you make of that report?
Well, yeah, you nailed it before, Lindsay, in terms of the issue was civil. Civil is looking soft in the short term right now, and that's sort of been the driver. I mean, they're setting themselves up for defense longer term, but simulators have always been their business, and that's obviously tied to the building and training on aircraft and airlines. So that looks a little softer. They're doing a bit of a restructuring there. So, but yeah, I mean, the earnings generally are coming in well. I think the bigger tell is what's going on in the technology sector, and why that. I mean, that the one that blew me away this week was Shopify. Those are huge numbers. The stock went up 15% pre-market on Wednesday, finished the day down about 12%. That's illuminating in terms of what's actually going on in the market, to see a reversal like that in a single day.
Yeah, Shopify had some pretty phenomenal earnings, and you believe management said all the right things in that earnings call when they were talking about, the report, public call it on the sell side, callback side.
Yeah, and I think the worries right now in the market is just that you're going to have so many disruptors. Suddenly, AI is not this great tailwind for the market. Suddenly, it's a destabilizing threat. You saw that the other day on the financials. A new app comes out, and that's going to undermine all the financial companies. That was the same thing for logistics yesterday. So, and the problem, I think, too, Lindsay, is just the over-owner. This just shows that too much money was in the market generally, and it's been all in tech. So people, as they unwind these bets, they overshoot on the upside, and then they're probably going to overshoot on the downside. So you create some great bargains in the process. And I think, Microsoft, Shopify, names like that are looking pretty good buys right now. But in the short term, yeah, they could go a lot lower. I saw this in 2001 and made the mistake of buying too early on the dip. And man, these things dropped 70 to 80% before they finally bottomed out.
Yeah, it's going to be an interesting ride from here on. That's all the time we have today, though. John Zechner, chairman and founder of J. Zechner Associates. Always good to have you join us. Thanks so much.
Thanks, Lindsay.
Coming up, the United States is facing another government shutdown as additional funding for the Department of U.S. Homeland Security is set to expire at midnight, and lawmakers have no deal in sight. So we've got more on that coming up right after the break. The U.S. House of Representatives passed a resolution this week against U.S. President Donald Trump's tariffs on Canadian goods, delivering a message to the administration for launching a trade war against Canada. CTV's Rachel Aiello has more in this report.
The joint resolution is passed.
By a vote of 219 to 211, the U.S. House passed a resolution to repeal President Donald Trump's so-called fentanyl tariffs levied last year, citing border security. These 6 House Republicans breaking ranks to join the Democrats in backing the move.
This is the right vote for my district. These tariffs are hurting them, and again, that certainly weighed in my vote on this.
Well, I've got to represent my district, and Canada and the state of Washington are have very close trading relationship. It's valuable.
And while largely symbolic, it's a sign some Republican support for Trump's use of emergency powers is slipping.
I think it's an early indication that over the course of the next 6 months, we're going to see a little more month-by-month erosion in the support for the president among the Republican caucus, both in the House and the Senate.
Defending his trade agenda, Trump said any Republican in the House or the Senate that votes against tariffs will seriously suffer the consequences.
I'm disappointed in the vote, but the president has veto power.
The resolution now goes to the Senate, but without the 2/3 majority needed to override Trump's expected veto, the tariff policy won't change.
So it's a good step, but it's a small step.
Still, experts say it positions Canada better heading into the CUSMA review.
I think it actually gives Canada a little bit of additional negotiating power, right? But it just highlights to the president and to the U.S. administration that Canada has allies here.
The U.S. Supreme Court is separately weighing whether Trump can continue to use these emergency tariff powers.
That was CTV's Rachel Aiello. Well, the Department of Homeland Security is now set to lose additional funding with a partial government shutdown looming. Democrats are demanding changes to President Trump's immigration crackdown. ABC's Nicole D'Antonio is in Washington with those details.
This morning, a partial government shutdown looms with additional funding for the Department of Homeland Security set to expire at midnight, and lawmakers now headed out of Washington with no deal in sight. Senate Democrats voting unanimously to block a DHS spending bill after the fatal shootings of Alex Preddy and Renee Good by federal agents in Minneapolis. They want changes to immigration enforcement, which include requiring ICE agents to get warrants signed by a judge before making arrest. And they want to ban agents from wearing face coverings.
What Democrats are demanding is reasonable and it is necessary. None of what we are asking for is extreme for local law enforcement. So why don't those basic standards apply to ICE?
Republicans argue there aren't enough judges to sign so many warrants and that unmasking agents will put their safety at risk. It comes as Border Czar Tom Homan says the massive immigration operation that's been going on for months in Minnesota is coming to an end.
But I'm not going to sit here and say anybody did anything wrong and that, they were, unprofessional. I'm going to say there's some issues here. We fix those issues.
Minnesota Governor Tim Walz is demanding the government, quote, pay for what they broke.
They left us with deep damage, generational trauma. They left us with economic ruin in some cases.
If Homeland Security does shut down, a number of other agencies will be impacted. Airports could see the most immediate impact. TSA agents will be required to work but won't get paid, similar to what happened after the government shut down last fall, which could trigger a wave of sick calls leading to delays.
These same agents who went without a paycheck for 43 days because of the failure of the Democrats to come to the table then. It's exactly what we're seeing now.
And a new poll shows that a majority of Americans, more than 60%, believe President Trump's deployment of immigration agents in U.S. cities has gone too far. Nicole D'Antonio, ABC News, Washington.
Coming up after the break, we will be joined by Manulife's chief financial officer to get further insights into the company's finances in this latest quarter. That's coming up next. Hi there. Welcome back to the Open. We're going to take a really quick look at the markets. We're about 10 minutes away from the opening bell, so we want to see how things are doing in the midst of a bit of turmoil in the U.S. Of course, we're watching for a potential U.S. government shutdown. We've also got those CPI numbers from the U.S. coming out this morning, basically a little in line with what analysts were expecting, up 2.4%. And you can see the Dow Jones, the NASDAQ, the S&P 500 all currently trading down ever so slightly at the moment. Investors may be a little cautious heading in today, expecting to see potentially, as I mentioned, that government shutdown in the U.S. So we'll be watching these markets today, particularly when they open, as well as how that affects the TSX. We can take a quick look at gold as well. Prices of gold this morning before the opening bell. We know gold has been on a bit of a wild run recently. Currently up by 1.5% after we saw it reach another high yesterday, but it's been on the ups and downs, and gold and silver prices plunging yesterday afternoon after a big tech sell-off. So we'll be watching that today as well. Meanwhile, turning to other news we're following, in its latest quarter, Canadian insurance company Manulife Investments announced new mutual funds to bring additional access to investors. So let's get more on this from Colin Simpson. He's the chief financial officer at Manulife, and he joins us live now. It's good to have you. Thanks so much for joining us.
Yeah, thanks for having me. Happy Friday.
Happy Friday to you as well. It's great that the weekend is here. So if we're taking a look at these numbers that came out yesterday, Manulife reported a $1.5 billion in its latest quarter. But I noticed yesterday Manulife shares fell as much as 5% after reporting. So I'm wondering what you make of this latest quarter. How are you feeling about the report?
Yeah, look, we were really happy with our numbers. We saw earnings go up by 5%, and on a per share basis, up by 9%. We felt so confident in our outlook. We increased the dividend by 10% and announced a new share buyback by 2.5% of the company. So things went really well for us in the quarter. I think the reception to the results and the results in share price decline, some of that was due to softer Asia sales than we've seen in the past. And we'll always prioritize value over volume. So, we certainly weren't concerned with our Asia numbers. And in fact, Asia earnings were up 24%. The other area that got some questioning on the call was we saw $9.5 billion of net outflows in our asset management business. But this was largely a function of what we're seeing in the market and some very seasonal retirement fund flows. So when you put that to one side, really strong earnings growth out of our asset management business. So feeling really good about the quarter and looking forward to the near future, really.
Mm-hmm. And I don't want to take away from the positives of this report, but you did mention, sales in Asia, sales in Hong Kong in particular were down in Q4. Despite strong performance throughout the year in Asia. So what do you make of that? What drove those sales being down, do you think, in that quarter?
Yeah, and we sell in Hong Kong, we sell through a variety of different distribution channels. So we have our own agents that sell our products. We have banks, and then we have independent agents. And what we saw this quarter was that independent agent channel having a tougher period for us. And part of that is there's been some regulation change. And so there was a little bit of disruption in that channel. Now, the important thing to note is that our own proprietary channel and the bank channels have higher margins. So while sales were down in Hong Kong quarter over quarter, margin was up really strongly. Actually, we had a 52.4% margin. A year ago, that margin was 39.7%. So when you take a step back, actually, and look at the overall sales growth in Hong Kong for the full year, it was up 21%. And that sort of demonstrates that the comparator was quite tough for our Q4 numbers.
Manulife also announcing that you're launching ETF-based mutual funds. Tell us more about that and what investors can expect from that.
Yeah, we want to be the number one choice for customers. And so our drive is to provide customers how they want to invest, what they want to invest. We want to give them as broad an opportunity as possible to invest. And ETFs are a core part of our product offering. And in fact, through John Hancock, the brand that we trade in the US, and through Manulife in Canada, we're able to offer ETFs to give customers that extra choice. When you look at what we offer as a company, we go all along the credit, equity, and infrastructure spectrum. We've got a fully illiquid private credit business that we offer through our Comvest Credit Partners. We've got semi-liquid through CQS based out of London. And then we've got the broad-based Manulife funds that offer public credit with a fantastic track record. So you put all that together on top of really great infrastructure opportunities, and you add the option for customers to invest via ETFs. And we think Manulife is a fantastic option for our customers.
You also announced a new global credit strategy, a couple of announcements yesterday. So tell us more about this strategy.
The global credit strategy, look, there's no real change to global credit for Manulife. We remain very constructive, and we pursue a diversified strategy. We operate in in 14 different countries in Asia. So having people on the ground really gives us that opportunity to assess credit as it happens on the ground, gives us great knowledge locally, and you put all that together, and we remain relatively constructive on the credit space. We do think that the economy will not necessarily struggle too much in 2025, 26, but it's certainly not going to be, a blowout year. And so things like the short-term interest rate, we expect it to remain fairly constant until well into 2027 here in Canada, and that's really reflecting a credit environment that will continue to muddle along, I think.
Is that one of the headwinds, if you want to call it a headwind, that you're anticipating in 2026? I was going to ask you what challenges you see lie ahead for Manulife, and the economy kind of, as you say, like muddling along, maybe could be one of those potential challenges?
Yeah, the great thing about a life insurance company is that a lot of our earnings stream comes from business that we've already written. And so, when you think about some of the challenges, some of the macroeconomic challenges and the geopolitical concerns, that doesn't really impact our earnings per se. But should we see leakage of that into the credit markets, certainly I think the whole financial services sector could see that as a challenge. But I will say, we operate really in the public credit space, so quite high up in the quality spectrum. And in fact, we had a really good credit experience in the fourth quarter, and that's reflective of the fairly benign credit environment, particularly in the public space where we operate.
Okay, Colin Simpson, Chief Financial Officer at Manulife. That's all the time we have, but it was good to have you join us this morning. Thanks so much.
Fantastic. Nice talking. Thank you.
Thank you. Stay with us. The opening bells are next. And here are the opening bells at the NASDAQ. The Heart Speaks Foundation rings the opening bell. The New York Stock Exchange, BlackRock, is ringing the opening bell. It's time for the first 15. This is BNN Bloomberg. Trading day is just getting underway today. We will check in on the equity market. We will take a look at the markets now that they are open. And here it is. TSX is trading ever so slightly up. The S&P 500 also basically unchanged, and the NASDAQ pretty much unchanged at this point, too. We're going to be watching for a lot of things today, including a U.S. government shutdown, a potential shutdown that could move the markets quite a bit. And if we take a look at some of the stocks that are moving, particularly on the TSX, we'll start there with some Canadian companies, including Air Canada. Air Canada reported its third quarter earnings and profit of $296 million, which was up from last year as domestic Atlantic travel drives fourth quarter beat. And so Air Canada up more than 6% to start the day. We'll continue to watch that one. Agnico Eagle Mines also reported fourth quarter earnings. These are interesting. Adjusted EPS beat estimate, sales also beat estimate, and now Agnico Eagle is topping Barrick in gold output to claim the number 2 spot for the largest gold mining producer in the world. So knocking Barrick Mining off that spot. So we're going to continue to watch that. Agnico Eagle up more than 2% to start the day. Also, Airbnb reported after the bell yesterday. Shares gained as the company's first quarter revenue forecast beat estimates. You can see right now Airbnb up almost 8% to start the day. If we also take a look at Applied Materials, that stock is soaring after sales forecast crushed estimates. You can see Applied Materials is up more than 10%, almost 11% right now. We're also watching Pinterest, which is actually sinking a lot as weak ad trends spurred analyst downgrades for Pinterest. Pinterest currently down almost 23% to start this Friday, so we'll watch that as well. And coming up, some portfolio moves to consider in an uncertain market environment. That conversation is coming up right after the break. Stay with us. Market volatility has been weighing on investors' decision-making recently, especially in the AI trade. But our next guest says taking a broader approach could lead to some good results. So let's get more now from Whitney Stewart, Executive Director and Client Portfolio Manager at Sterling Capital. It's good to have you join us. Good morning.
Good morning.
So taking a broader approach, what exactly does that look like for most investors, do you think?
Yes, well, the AI trade is the key trade in the market. We like to think of the AI opportunity as a 5-layer cake. Actually, CEO of NVIDIA, Jensen, really identified this analogy. So the bottom of the cake is the power generation opportunities that power all of the AI. Layer 2 is the chip companies. Layer 3 are the data center companies like Amazon, Microsoft, Google, Oracle. Layer 4 are the model companies. Think of Anthropic, OpenAI, and Google Gemini. And layer 5 are the application layer. That layer is seeing the most pressure today. Software application companies are seeing significant drawdowns. We believe the easiest way to take advantage of the AI opportunity right now is in the early stage, layers 1 through 3. Those you can identify winners a little bit easier. Layers 4s and 5 seem to be more challenged, and the market would suggest that layer 5 is the most challenging in the current stock price action.
So with that said, then, do you think investors' fears over AI are being a little overblown right now? Or is that why you think investors should be taking this kind of layered approach and sticking with the bottom layers?
Well, it's to be determined. The market is suggesting that the top layer, layer 5, the software application layer, is the most difficult. The investors are shooting first and asking questions later. You're seeing what some people may call SaaS apocalypse, or Valentine's Day massacre. These companies are down, in some cases, 25, 30, 40, 50% in the last few months. So the market is, again, suggesting that is the most difficult, maybe too hard bucket for investors today. We would generally agree that's the most challenging, and there is a lot of competition. So Anthropic, which is an enterprise AI private company, even OpenAI, they have their own enterprise AI that is going after enterprise software, which is a huge market. Both of those companies in the private market are targeting to generate $100 billion of annualized revenue by 2029. One of the key ways they're going to do that is to capture part of this enterprise software pool of profit.
So what does that mean then? Like, do you think this is the beginning of the end for the software sector and a lot of software companies, or is this just a time for them to kind of adapt?
I think it's going to be some software companies will be very challenged, and they may not go out of business, but their stock prices may be quite challenged for a period of time. Some will adjust and will take advantage of AI, and this will be beneficiaries. But that's what the market is trying to figure out here in the short term. The other key thing to think about is that software companies historically have traded at very high valuations because they've had reoccurring contractual revenues and they grow fast and high margins. If you can create software using AI at a much lower price point, and you can create a lot of it for super cheap, the moat of those software companies may be eroded. Therefore, the valuation, which was up here historically, maybe that needs to come down. And that means that these stocks maybe become a little bit less valuable or a lot less valuable in the future. Again, we tend to focus, at least in the short term, here on the layer 1 through 3. We do believe there are opportunities in layer 5, but it's definitely more difficult to determine that in advance, at least at this stage.
Okay, so throughout those layers, are there any specific stocks that are kind of dealing in AI that you're watching for that you like right now?
So we like, again, a lot of the chip stocks. So if you think about the way the cash flows are going today, the data center companies, Amazon, Microsoft, Google, and Oracle, and Meta are spending hundreds of billions of dollars every year on AI capex. That capital is flowing into layer 2 and layer 1. And so the easiest way to generate the earnings growth is to be a chip stock selling into the data center or a power company. And the simple way to think about it is the data centers today under construction is a doubling of the current square footage of data center existence. So in other words, we're going to see at least a doubling over the next 2 to 3 years of square footage of data center. And guess what goes in the data center? The chips, and you need power to power it. So again, we think a lot of those opportunities in layer 2 and layer 1 are the most visible, and therefore we're more attracted to those companies.
Beyond AI, where do you think investors should be looking for potential?
Well, the market is suggesting there are other opportunities outside of AI. And so what you can see, for example, the Mag 7 was the big story the last 2 or 3 years. The Mag 7 year to date is actually generating a negative return of roughly -3%, where the market is favoring companies, what you might call old economy or less disruptive areas in small caps. Small caps index is up 7, 8, 9%. You're also seeing value stocks, dividend stocks up 8, 9, 10%. So there are other areas that have less AI disruption risk. Those companies tend to be more physical, less digital. They tend to have business models that don't rely on software. And so those companies are seeing an improvement in their stock price year to date. But also the key point on small caps is that their valuations were really cheap, really low, and their expectations were low. So what's happening in small caps, they're having a lot of beat and raise on the earnings, and the stocks are reacting positively. In the large cap growth, Mag 7, the expectations are really high, and the valuations are high. And so those stocks are facing tough comparisons. And so they're reporting pretty good numbers, but they're not beating the expectation in many cases, and the stocks are going down. So we do think there are other opportunities, particularly in U.S. small caps, large value, dividend stocks, where expectations are lower, valuations are lower.
So particularly U.S. small caps is what you're talking about when you're talking about, potential small caps that investors should be looking at? Like, where should investors start to look if they're just getting into looking at small caps?
Yeah, so one of the things about the small cap market is there is a lot of low quality. So 40% of the small cap index doesn't generate any profit, actually negative earnings. So last year, you saw a big rally in the negative earning companies. That's now transitioning in 2026 to the profitable companies. We view quality as a long-term opportunity, and those companies are just starting to work. So in our view, you want to look for companies with profits, strong balance sheets, consistent free cash flow, high return on equity, and that will help you narrow down your search for companies that we believe have long-term durable earnings growth and are still attractively valued.
Okay, we will leave it there, but it's so good to get your insight on all that. Whitney Stewart, Executive Director and Client Portfolio Manager at Sterling Capital. Thanks so much for joining us.
Thank you.
Yesterday on Market Call, we were joined by Stan Wong, Portfolio Manager at Scotia Wealth Management. His focus was North American large caps and ETFs, and these were his top picks. You've got BHP Group, GE, Renova, and Vanguard International High Dividend Yield ETF. Joining us today on Market Call is Nadeem Kassim. He's Chief Investment Strategist and Portfolio Manager at Marnoa Private Wealth Council. His focus will be on North American stocks. And just ahead, U.S. President Donald Trump announced the repeal of several greenhouse gas regulations at a news conference last night. We've got more on that coming up right after the break. The U.S. Environmental Protection Agency is rescinding the legal finding to limit the heat-trapping pollution that spews from vehicle tailpipes, oil refineries, and factories. For more, we're joined now by CTV's Jeremy Sharon with the latest. So, Jeremy, this is some big news. What effect will this have on climate change and the auto sector going forward?
Yeah, Lindsay, look, this is significant. This is a rule that was used to underpin climate policies in the U.S. and emissions regulations, not just in the auto sector, but when it comes to power plants, oil and gas industry facilities, any kind of pollution. This is the ruling that was used to justify some of these regulations that were put in place. And so this is a significant shift in the way the U.S. administration is approaching climate policies. We know that in the past, U.S. President Donald Trump has called climate change a con job. And this is, a large-scale deregulation and will significantly hinder the Environmental Protection Agency's ability to, put forward policies to, impact pollution and to try and limit the greenhouse gases that are being emitted. So this is significant in that it will, stop the administration and stop the EPA from moving forward with climate policies. In fact, it will retract a lot of the climate policies that were in place. And then it has a significant impact on the auto sector, where it means that moving forward, auto manufacturers will have different rules and regulations to follow, less stringent rules and regulations. And the administration made it clear in this announcement that they are looking to take the pressure off the auto sector from producing more low emissions vehicles and electric vehicles. So this is a significant decision that will have serious impacts.
Yeah, no kidding. So we know that former President Barack Obama obviously established that framework in 2009. Has he responded at all to this repeal? And what's been other responses we've been getting from maybe the public?
Yeah, he has and has pushed back, understandably. As you've touched on, in 2009, it was under his administration that this rule was put in place. He took to social media to call this out, in part saying that without it, we'll be less safe, less healthy, and less able to fight climate change. Also, the fossil fuel industry can make even more money. That's former U.S. President Barack Obama saying that. What we've also seen is large climate institutes in the U.S. Already come out against this and have said that they have been working for some time to prepare for the possibility of this repeal and to sue over the decision to repeal this rule. So certainly I think we can expect pushback. The Sierra Club, which is the largest environmental group in the U.S., says that Trump has formalized climate denialism as official government policy. So certainly there's a lot of pushback here, Lindsay, and I think that we can expect to see, legal pushback as well. This won't be the end of this story necessarily.
And just lastly, too, we saw the Environmental Protection Agency's administrator, Lee Zeldin, accompanying the president yesterday. He was calling this the repeal the largest deregulatory action in American history. So I wondered, what does this have any effect on Canada moving forward as well?
I think it absolutely does, because you look at the fact that Canada and the U.S. in the past have been pretty lockstep when it comes to climate policy, specifically when it comes to emissions regulations in the auto sector. The North American auto sector as a whole had been, cohesive. That is changing, of course, with tariff policies and stuff. But now we're going to see a serious decoupling of that, and we're going to see significantly different emissions regulations in the U.S. and Canada, which could cause a few different things. It could, make it difficult for Canada to enforce its now more stringent emissions regulations, but it could also stop our country from importing certain vehicles that are now going to be manufactured without these regulations. So there are certainly many scenarios, and I think certainly it is likely that this has, in the long term, if this decision remains, that this has a significant impact on the auto sector and you know, how many vehicles we bring in. I think it's hard to imagine a world where the big auto manufacturers in the U.S. start manufacturing one version of a vehicle for the U.S. and then another for Canada. It's probably not worth it for them to do so. So the more likely scenario is Canada's forced to import vehicles that don't meet the regulations that exist here, or they stop importing those vehicles, right?
Very interesting. Okay, lots to watch for there. That was CTV's Jeremy Chiron joining us live. Jeremy, thanks as always.
Anytime.
And coming up, we will do an in-depth check on the markets, and then we'll tell you why SPACs are returning to the market as well. That's next. Stay with us. Welcome back. Here is how things are shaping up on the markets today. We'll begin with the U.S. markets, all trading down at the moment. Of course, a lot to watch for in the U.S. today. A potential government shutdown looming. We also got the CPI data coming out this morning from the U.S. that seems to be affecting investors' confidence this morning. If we take a look at how major Asian markets finished the day today, all finished the day down as well. AI concerns seem to fuel a sell-off there. That sell-off seems to be continuing over the last couple of weeks in Asia. And moving over to Europe, markets are mixed to start the day there, and continue trading, I guess, for the FTSE, the CAC 40, and the German DAX. And also, if we take a look at where the TSX is today, after a bit of a sell-off yesterday, it seems to be rebounding. It's up by 0.4%. Of course, we saw a sharp sell-off of gold and silver. That always seems to affect the TSX, but gold and silver also rebounding today. We'll take a look at that in a moment. Speaking of the TSX, we'll take a look at some of the biggest winners and losers yesterday from a percentage standpoint. Sun Life Financial, one of the biggest gainers, up more than 6%. Keyera up almost 4%. In terms of the biggest laggers, WSP Global was down to end the day, almost 13%. And Nova Gold Resources, the biggest lagger on the TSX yesterday, down almost 14%. As I mentioned, we saw that sharp sell-off in gold prices, and that, of course, affected the gold mining stocks on the TSX. And when it comes to some of the other movers today that we're watching for, Air Canada reported a third quarter profit of $296 million. That is up from last year, saying domestic Atlantic travel is driving fourth quarter beat. And you can see Air Canada up almost 7% to start the day because of that. We're also watching Agnico Eagle. That mining company reported results that beat estimates. It's up more than 2%. It's also now knocked Barrick Mining off the second spot of being one of the biggest gold producers of the world. Barrick Mining was the second largest gold producer. Agnico Eagle has now taken that spot from Barrick. And I told you we're going to take a look at metals. We'll take a look at that right now. The price of gold is rebounding after a sharp drop yesterday. Gold up 1.3% to start the day. Silver also rebounding almost 2%. Copper not seeing that rebound, though. You can see it's down by 0.5% today, or at least right now. And if we look at the price of oil, it is down by 0.3% to start the day. Curiosity around AI and quantum computing has led to a new crop of SPACs coming to market. You might recall these investments were hot a few years ago, and they're known for taking investors on wild rides. So BNN Bloomberg contributor John Ehrlichman has a new story on our website about SPACs. John, of course, hosts the investing channel Ticker Take on YouTube, and he joins us now live. So, John, can we say SPACs are back?
It feels that way, Lindsay, and I know in a week or month where tech has been on a rocky ride, you might not think the interest would be strong, but just to back up a sec, yes, these what are called special purpose acquisition companies were quite popular a few years ago as a way for younger emerging growth companies to go public. I mean, they can go public through an IPO as well. Usually it's just a bigger hurdle for a small company. We're talking a lot right now about the possibility of big companies like OpenAI and SpaceX going public this year. They benefit from growing in the private markets over a period of time. SPACs typically are targeted around companies that are much earlier stage. And even though things have been rocky in tech for, call it, the last month, the momentum, as you mentioned, that we've seen for AI, quantum computing over the last year and a half, opened the door for some very small, younger companies, including Canadian ones in that area, to go public through a SPAC, where basically there's a shell listing that merges with the company and boom, they go public. And Julian Klimachko of Accelerate, who watches different trends in the market, spoke with us on Ticker Take. It's on the BNN website and our YouTube channel about 5 in particular that could be worth watching. And his reminder to everybody is these things can have roller coaster rides, but if you're interested in these themes, if you're very bullish on these trends that everybody's been talking about, these are some interesting earlier stage companies perhaps to be tracking.
So I'm not sure if you want to go through those 5 or some of the other SPAC winners that we've been seeing in recent years.
You know, people can definitely go check out on the website. It's on the homepage, some of the examples that Julian's talking about. They're not going to have that name brand recognition that some of the public companies that we talk a lot about today do. But I thought it'd be better to take a look actually at some of the stocks that began their life as SPACs, because you get to see sort of that plus and sometimes negative story. Now, the stocks we're going to talk about would include Vertiv, which has been a very popular AI play, benefiting from all the demand for cooling with AI and data centers. You've got companies in the space market like Rocket Lab. I was talking about how SpaceX is going public. You've got some space companies that have frequently gone through the SPAC route to get to the public markets. You've got companies like Oklo, which has a connection to Sam Altman of OpenAI fame, which is leaning into the nuclear trend. All of those names have done well. DraftKings has done well since its SPAC debut. But that's the positive side, Lindsay. There are plenty of SPACs that have been disappointing, to say the least. You know, you think about high growth stories like Lucid, Virgin Galactic, which have been huge disappointments. So this is an area, especially if we're in a risk-off market, that might lose some momentum. But if the AI and quantum stories come back, people can check out some of these new names that are coming to market, which, at least from Julian Klimachko's perspective, could be worth watching over the long term.
Okay, we will leave it there. John Ehrlichman, thanks so much for that. You can find John's story on the BNN website and his Ticker Take YouTube channel. Thanks, John. And just ahead, we're looking at the U.S. CPI data and a slew of earnings results. That's coming up after the break. Stay with us. Hi there. Welcome to the second hour of The Open. We're going to take a look now at some of the stories we're following for you in the BNN Bloomberg newsroom. Shares of Air Canada are soaring after the national airline posted higher than expected revenue and profit in the fourth quarter. Air Canada says the results were driven by growth in domestic and Atlantic travel, which offset weakness in travel between Canada and the U.S. There was also stronger than expected demand across both cargo and passenger segments. And shares of Agnico Eagle Mines are edging higher today. That's after the company beat profit estimates in its fourth quarter and saw revenue from mining operations come in above consensus. A bright spot in the quarter was Agnico's gold output. The company has now surpassed Barrick Mining to become the world's second biggest gold producer. And shares of Hydro One are trading higher after posting fourth quarter profit and revenue that beat estimates. The Canadian electrical utility says it has partnered with First Nations communities and secured the necessary funding to begin work on the Chatham to Lakeshore transmission line. The CEO says the project is the first to be developed under a 50-50 equity model, calling it a meaningful step toward reconciliation. And we'll take a quick check on the markets. The TSX is rebounding after falling yesterday. It's up by 0.8% at the moment to start the day. And mixed trading south of the border. If we take a look at the U.S. markets, well, it was mixed. Now they're all trading down at the moment. A lot of investors watching for that potential U.S. government shutdown. Also, those CPI numbers that came out today. We'll, of course, be talking about that coming right up. right now, investors are digesting the latest economic data from the U.S., which shows inflation slowed more than expected in January, offering hope, and the U.S. inflation problem could be easing. Consumer price growth slowed to an annual pace of 2.4%. So for more on that, we're joined now by Andrew Pyle, Senior Investment Advisor and Senior Portfolio Manager at CIBC Wood Gundy. It's good to see you. Thanks for joining us.
Good to see you, Lindsay. Thanks for having me.
So I'm wondering what you make of these latest CPI numbers. Do you think it offers a bit of hope?
Well, I think there's a glimmer of hope. Markets are obviously relieved this morning. I think given what we saw in anecdotal energy costs in the month of January, given the cold snap in the States, a lot of economists were, anxious that this number could come in on the hot side. It didn't. So that's where your relief rally is coming from this morning. I don't think we're out of the woods. And, a lot of people are talking this morning, Lindsay, that this puts Fed easing back in play, perhaps for the first quarter, second quarter. I honestly don't think the Fed is going to change its game plan just based on this one number. There's still a lot of uncertainty in the inflation makeup for the States.
Okay, that was going to be my next question. So you don't think there's going to be a change in terms of the Fed's plan? So how many rate cuts do you think we're going to see this year? I know some analysts are saying 2, some are saying maybe 3 now. What do you think?
Well, we still think you could get 1 to 2, and I think that really is dependent on the fact that inflation has to remain down in these levels or lower, because that's the only way you're going to get 3, 4 or more is if you have either a more protracted decline in inflation, which we don't think is in the cards right now, or in fact you get an outright recession in the United States, which obviously would put the Fed back in the game. I think for now we're sticking with the 1 to 2 rate cut plan for 2026.
Okay, so we'll obviously keep watching that. But of course, we're watching earnings coming in today. We've got a couple of different companies I know that you wanted to discuss. We'll start with Agnico claiming, I think this is interesting, in the latest results from Agnico Eagle, actually claiming the number 2 spot for gold output, knocking Barrick Mining out of that spot. What do you make of what we're seeing from Agnico?
Well, incredible results. Obviously, we're keying off the extremely high price for gold, but I think it's also the fact that we're seeing output increase. And I think that's where analysts are going to be very happy this morning. Obviously, owners of the stock are going to be very happy. We've seen the stock pop. So they're really delivering on all the guidance that they have given in the last recent while, that they can increase output, they can get those margins to improve with this higher price of gold. And again, a lot of investors are going to sit up this morning, Lindsay, and say, okay, so now second largest company in the world, this really gives you an even more or an even stronger demand push for the stock.
We're also watching Air Canada. Obviously not the best week for Air Canada after announcing that they were going to be suspending flights down to Cuba, obviously because of a fuel shortage there. So not good news for Cuba either. We saw shares of Air Canada go down this week, but reporting a beat in profits, Q3 profit up $296 million from last year. What do you make of what you're seeing from Air Canada?
Well, it's a theme that you're going to see across many different sectors and many different companies, Lindsay, and that is, this shift in travel towards Europe and towards domestic based on what we've seen coming out of the States. Travelers simply, steering clear of destinations that they once would have just gone to and where Air Canada flies to, but now, moving those plans domestically and abroad into Europe. Obviously, you've got the Olympics as well. So, the company is reaping the rewards from that, but we've seen that also, for example, in Airbnb, where we're seeing increased travel demand in those other areas outside of the States. So, I think great results this morning. It's obviously a relief for the company after the turbulence, pardon the pun, that we've seen in the stock over the past week.
It is interesting to see some of these companies, like as you mentioned, Airbnb as well, almost benefiting in a way from what the tensions that are going on between the U.S. and Canada. And I guess that will continue until we reach some kind of deal with the U.S. Is that right? Like what I'm asking is, will Air Canada and Airbnb continue to be able to offset what we're seeing in terms of that tension between Canada and the U.S.?
I think they can. I mean, obviously, this is hugely uncertain right now. There is no clarity to this situation whatsoever. It's as clear as mud as we sit here today. So we honestly don't know. What we do know is, the traveler's choice in terms of destinations. I mean, when we look at Europe, for example, Lindsay, I mean, this is a high cost area when we start talking about things like hotels and hotel travel. And that's where, again, a company like Airbnb picks up the slack, because travelers are going to look for that experience, but at a lower price point, and therefore they're going to go to the likes of an Airbnb, and that's why I think we're seeing the results that we're seeing.
Okay, we're also watching Applied Materials up more than 11% right now after reporting pretty good results, upbeat sales forecasts. What do you think is contributing to what we're seeing with Applied Materials?
Well, still extremely healthy demand for semiconductors, which is AMAT space. Stock has done extremely well. It's interesting after a week like this, Lindsay, where we're hearing more and more analysts and investors talking about a broadening of a sell-off in tech in general, obviously reaching into the likes of software, that you still find these pieces or these slivers of hope in that sector. And Applied Materials is one of them, where that demand for semiconductors continues to improve. Demand for memory obviously continues to improve, and companies that are in that space will continue to do well, even if you have a general kind of decline in sentiment for the sector as a whole.
And lastly, I know you wanted to talk about Bombardier. I think this is going to be an interesting company to watch in 2026. They beat in revenue and surpassed his 2025 guidance, but maybe, again, maybe some turbulence ahead for this company. What do you think?
Yeah, I think a little bit of a cautionary tale. I mean, the results are great. The market likes what they're seeing, but we have to deal with the states. We still don't know what is going to happen with respect to the FAA's decision on Bombardier, on planes coming out of Bombardier. So, that's a huge question mark right now. If it gets resolved, I think we're all clear for 2026. But that's one thing that I think is going to keep investors on the sidelines, just to see exactly what happens, what is the future for this company or this company's products with respect to the states.
Absolutely. A lot to watch for. Andrew Pyle, Senior Investment Advisor and Senior Portfolio Manager at CIBC Wood Gundy. It's good to have you. Thanks so much for joining us. And coming up, Canadian auto parts giant Magna International beats Q4 estimates and unveils bullish 2026 guidance. So is it time to buy? We'll find out right after this. Despite U.S. tariffs and uncertainty around the future of CUSMA, Canadian automotive supplier Magna International delivered a solid beat in Q4 and introduced stronger than expected guidance for 2026. The stock was up 26% over the past 6 months. Today, it's up more than 18%. Will it see further upside? Let's find out with Jonathan Goldman, analyst at Scotia Capital. It's good to have you join us. Thanks for your time.
Thanks for having me.
So I'm wondering what stood out to you in the latest quarter, first of all. Let's just go through some of the results.
Yeah, really strong results out of Magna, I think, on EBIT. It was a 10% beat. And really what drove that, and actually what's been carrying the performance all year, is the company's ability to control what it can control. So I think in your opening, you alluded to the tariffs and the challenging operating environment. Part of that is vehicle prices going up. So you don't really have any control on how many units you're going to produce. But what you can do is you can look at costs or operational excellence, managing workflow, optimization, procurement, and really controlling your side of the ledger on that regard. And they've done a fantastic job on doing that and driving margin expansion when normally you would need vehicle volumes to increase to do that. And they've still managed to do it every year, and they're still going to do it going forward. And it seems to be a core part of the strategy now. So pretty optimistic about next year and likely good visibility in them achieving those targets.
But what's interesting is Magna's 2026 guidance excludes the impact of tariffs or uncertainty over CUSMA renewal. We've got that renegotiation coming up in the summer. How realistic is that outlook to exclude those things?
It's a good question. There was some impact of tariffs last year. So I think they even talked about a 10 basis point headwind on margins from tariffs. I mean, some of them they had to absorb. Some of them you did have commercial recoveries from customers, which is built into contracts. It's a very fluid environment, as you know. Things could change at any second, depending on what comes out on the social media cycle. It's tough to put in a model that for a company or for anyone on what the impact could be. They do have pretty robust mechanisms to recover price from their customers. And what I would say on the renewal of the CUSMA, it is a risk to the story, and I would say the industry generally, but it's in everyone's benefit to work together. As you know and your viewers know, it's a very integrated supply chain with things going back and forth across the border 6 and 7 times, also with Mexico as well. So maybe it gets reworked a bit. I heard it's focused a lot on assembly rather than production, which would kind of exclude Magna. But it seems to me that everyone is kind of to their benefit to come to a solution that works with everybody, so no one actually has to pay higher for cars.
Yeah, it's hard to kind of untangle yourself from a supply chain that's so intertwined, as you mentioned, right? Is that why you've maintained a sector perform rating on the stock? Like, what's holding you back from being a little more bullish on Magna?
Yeah, I guess I would take a step back and I would say I'm a little less bullish on the sector versus Magna specifically. I would say Magna this quarter, and I mean, I guess throughout 2025 has delivered and exceeded my expectations and the street expectations, and clearly again today. And it's nice to see the market rewarding them. My view on the sector is the input costs to make cars. I mean, we saw the announcement this morning on Trump potentially rolling back steel and aluminum tariffs, but labor has increased, other input costs have increased, freight has increased. There is some level of tariffs right now that are being baked into the cost of manufacturing a car. You could only absorb so much of that if you're a manufacturer, if you're a supplier, because the margins are very thin, as you know. Some of those costs will eventually get passed on to the consumer, I believe. And it's one of the most expensive items you can buy, you know, maybe outside of a home. Any increase in the price has a negative impact on demand. So that's always the risk we're running right now. If you see some more inflation, if the prices go up, you could see a negative impact on demand. And I guess just for context, I think the average price of a car right now in the US has crossed $50,000 US, and the average monthly payment is US $800. So that's quite a bit of chunk of change for the average household.
Yeah, and as you say, like, it's so hard for businesses. You know, we've seen so many Canadian businesses, at least, and probably American as well, trying to absorb the cost of these tariffs for the consumer. So you're not passing that along, as you say, but they can only do that for so long. Is that right?
Exactly. I mean, if you look at the OEM margins, they've come up a lot in the past year. I think we're back or even below the 2019 levels. And that does come at the expense of other things in the supply chain. So between the consumer, the suppliers, the OEMs, even miners, throughout that supply chain, the higher costs by tariff need to be borne by someone. Thus far, it's been mostly the OEMs. The risk then is if they pass it on to the consumers and suppliers to bear in some of those costs.
We know the Prime Minister, Mark Carney, laid out a new strategy last week when it comes to the kind of auto industry, very much focused around electric vehicles, also a potential decoupling from the U.S. There was a couple of things mentioned in his announcement last week, but I'm wondering how much of that affects Magna in particular, do you think?
It would probably affect the entire industry. I guess if we take a step back, I think the bigger question, rather than where the manufacturing is coming from or where the vehicles are coming from, is the outlook for EVs. Generally. So you've seen some pretty, big announcements from OEMs recently about taking write-downs and reshifting some of their focus to ICE vehicles, the traditional ICE-powered cars. I think that's the bigger question the industry is facing right now. We've seen the adoption curve kind of slow. Obviously, EVs are more expensive, and we talked earlier about these price and affordability challenges. I think before we even get into manufacturing and sourcing and geography and tariffs and those types of conversations, I think the industry really needs to recalibrate the level of EV penetration that we're going to see going forward. So I think there's a bit of a shift that's still happening right there. Maybe it comes down further. Maybe we've stabilized. But I think that's the main challenge the industry is facing, rather than, where the vehicles are coming from at this point.
And just very, very quickly, like, where does Magna sit in comparison with its competitors? Because I know you said, the whole sector is going through this, but where does Magna sit in comparison?
Magna's the leading NA North American supplier. They're the largest tier one North America, I believe, number 4 in the world. So these guys are at the forefront of anything. Mm-hmm. They are effectively the industry bellwether as far as the supplier goes. Obviously, you have your D3, your Ford, your GM, and your Stellantis. Magna is effectively that big in terms of the supply chain and supplier base, the tier one. So they really do set the tone for the industry. Everyone looks for them on guidance, outlook, and kind of having their ear on the ground of what's coming next.
Very interesting. Okay, we'll have to leave it there, but appreciate your time. Thanks for joining us.
Pleasure.
That was Jonathan Goldman, analyst at Scotia Capital. Coming up, why subsidies for Elon Musk's SpaceX could be the wrong target. We've got more on that right after the break. European leaders are trying to create alternatives to Elon Musk's SpaceX empire, which is growing in influence through its network of satellites and high-speed internet connections. For more on this, we are joined by Bloomberg Intelligence John Davies. It's good to see you. So we know that French President Emmanuel Macron has been quite vocal about this. Europe's satellite industry scrambling to keep up with Elon Musk and SpaceX. What could it be doing better, do you think?
I think the key thing is to work better together. It's a rather fragmented industry at the moment. Although there's quite a lot of support, they've not really been all doing the same thing. There are the beginnings of it. There's a network being commissioned called Iris Squared, but that's not supposed to be in place until 2030. And there are mutterings that various countries might want to try and build their own networks. And that really is not a good idea, given that in the modern infrastructure, the networks are global. So there's no point whatsoever in each country having its own thing. They should really much more be getting together to share their networks. And it's not necessarily a question of money. They're already spending tens of billions of euros in their budgets on space communications.
Interesting. I'm wondering, too, like what other countries like Canada, for example, or Japan or other similar countries could be doing as well.
Well, again, it could be a question of sharing and interoperability. Canada has its own project with a company called Telesat. Again, that's something that's currently only in the planning stages. They are, I think, in the manufacturing on the ground stage, but they haven't really launched anything yet. There could be some possibilities perhaps for these various countries to work together, at least pool their resources to come up with a common project, a common set of standards, rather than having lots of different ones trying to do more or less the same thing, but perhaps less well.
Is there maybe, in comparison with SpaceX, like some key technology that's missing within these other countries, like us or France or Europe as a whole?
Absolutely. I mean, the major thing is launch technology. So SpaceX, we know it as a Starlink as the internet access business, but the really interesting, exciting bit, I think, is the launch operation, which has already pioneered reusable rocketry and is moving on towards having extremely large reusable rocketry, and that's leaving everybody else quite literally in the dust. There's some element of potential of something very similar happening in France, but it maybe is a couple of years away at least, and that I think is an area for everyone to focus on, is improving the launch market.
Okay, we will leave it there. Bloomberg's John Davies joining us live. Thanks so much for your insight. Appreciate that.
Thank you.
Coming up, Applied Materials trend upward after beating estimates. We've got more on that right after this quick break. Magna International is the best performing stock on the TSX today. The auto parts supplier boosted its revenue and profit forecast for the full year after beating on the top and bottom lines in its latest quarter. Magna now sees revenue of up to $43.5 billion US, despite the decline in global vehicle production. Magna says it expects about 15 million vehicles to be produced in North America this year. CAE posted total revenue for its latest quarter that came in below expectations. Revenue in its civil unit also fell nearly 5% and missed estimates. The flight training company says the segment experienced softer order activity than expected. On the upside, CAE is boosting its 2026 outlook for defense. And shares of Enbridge are edging higher today. The energy company posted fourth quarter profit that rose 17%, driven by expanded operations and lower U.S. taxes. As a result, Enbridge has reaffirmed its 2026 targets, with the top end of its earnings outlook coming in above expectations. The quarter was also driven by major partnerships with Meta in the power space. And we'll take a look at North American markets to start your day. Mixed trading here. The TSX is up almost a full percentage point as we see those material stocks rebounding. The S&P 500 very slightly up, and the NASDAQ ever so slightly down at the moment. Shares of Applied Materials are soaring after the company delivered an upbeat sales forecast, signaling a high demand for artificial intelligence and memory semiconductors. For more on this, we're joined now by Atif Malik, analyst at Citi. It's good to have you join us. Thanks so much.
Thank you for having me.
So what are your initial takeaways from Applied Materials' latest earnings report?
A big beat and a bigger outlook. The focus for investors was their own commentary for the full year semiconductor system sales. Expectations were around mid-teens, and they are calling for a 20% growth this year, obviously driven by AI, advanced packaging, DRAM, foundry logic. So Applied Materials is back. It has been an underperformer last year versus peers like Lam Research and KLA. and the mix of spending is their friend this year. They have the highest market share in the DRAM market.
It does seem to show, right, what everyone has been talking about and predicting is that these companies that deal with semiconductors and also like the chip industry, that's all going to be trending up this year and doing pretty well because of this AI run we're seeing.
Correct. Memory components are in severe shortage. Looking at hardware companies' commentary as well as Qualcomm, it is impacting the demand for consumers on the lower end, but all that memory supply is going towards AI. So equipment makers like Applied Materials are in a good position because we need to add more capacity to meet that demand. And fab space is limited this year. So Applied Materials and peers, Lam, KLA, are looking at an extended upturn into next year because of a limited fab shell capacity.
With that being said, though, okay, so on that note, like, let's talk a little bit more about the risks for the company as we head further into 2026.
Right. The biggest risk on this group, including Applied Materials, has been China's sales. It has been roughly around 30% of equipment sales for them in the last couple of years. And China is looking to a more in-source. Also, there are restrictions by the U.S. government on leading-edge equipment to make AI chips in China. So that has been the biggest overhang risk for the last couple of years. And this year, the non-China demand outside TSMC, even Intel, Samsung is growing, and that's offsetting the risk in China.
Applied Materials also settled that U.S. Commerce Department investigation with a $252 million payment. I'm wondering, did that have any impact on the latest quarter that we saw?
No, it did not. It was a one-time fine by the company not following the export restrictions. We have seen cases like this in the past with hard disk drive companies also settling with the U.S. government when they were restricted. So no, it was a one-time event, but no criminal or long-term implications.
And we know that Applied also has a new partnership with Samsung. I'm wondering how meaningful that is. Like, is that something you're kind of watching for as we head forward?
Yes, Samsung, TSMC, and Intel combined are 75% of the global equipment spending. So Samsung obviously is a big spender. Them partnering with Applied Materials on this EPIC R&D center is a big endorsement that Samsung believes Applied Materials is the company that can help integrate all the processes required to make a transistor. Applied Materials is the most broad-based, diversified product portfolio. So Samsung, everyone needs to work with Applied Materials to make these devices work in the future, and Samsung's a huge endorsement.
You mentioned also that OPEX is rising. Where is the company investing there?
Yeah, the company always have to invest in R&D, new products, because making these transistors, advanced packaging, chiplets require newer processes, newer materials, as their name suggests, Applied Materials. They're always working on new materials. So the focus on the OPEX is always R&D. If 75% of your sales are 3 customers, you do not need a lot of salespeople to sell your products. So the focus on OPEX is always moving more towards R&D dollars versus SG&A.
Okay, we will leave it there, but it was really good to get your insight on Applied Materials. Thanks so much for joining us. Appreciate it. That was Atif Malik, analyst at Citi. Now, in its latest quarter, Canadian insurance company Manulife Investments announced new mutual funds to bring additional access to investors. And earlier, we sat down with Colin Simpson, Chief Financial Officer at Manulife, to discuss their latest quarter. In its latest quarter, Canadian insurance company Manulife Investments announced new mutual funds to bring additional access to investors. And earlier, I sat down with Colin Simpson, Chief Financial Officer at Manulife, to discuss their latest quarter.
We were really happy with our numbers. We saw earnings go up by 5%, and on a per-share basis, up by 9%. We felt so confident in our outlook, we increased the dividend by 10% and announced a new share buyback of 2.5% of the company. So things went really well for us in the quarter. I think the reception to the results and the results in share price decline Some of that was due to softer Asia sales than we've seen in the past. And we'll always prioritize value over volume. So, we certainly weren't concerned with our Asia numbers. And in fact, Asia earnings were up 24%. The other area that got some questioning on the call was we saw $9.5 billion of net outflows in our asset management business. But this was largely a function of what we're seeing in the market and some very seasonal retirement fund flows. So when you put that to one side, really strong earnings growth out of our asset management business. So feeling really good about the quarter and looking forward to the near future, really.
And I don't want to take away from the positives of this report, but you did mention, sales in Asia, sales in Hong Kong in particular were down in Q4. Despite strong performance throughout the year in Asia. So what do you make of that? What drove those sales being down, do you think, in that quarter?
Yeah, and we sell in Hong Kong, we sell through a variety of different distribution channels. So we have our own agents that sell our products. We have banks, and then we have independent agents. And what we saw this quarter was that independent agent channel having a tougher period for us. And part of that is there's been some regulation change. And so there was a little bit of disruption in that channel. Now, the important thing to note is that our own proprietary channel and the bank channels have higher margins. So while sales were down in Hong Kong quarter over quarter, margin was up really strongly. Actually, we had a 52.4% margin. A year ago, that margin was 39.7%. So when you take a step back, actually, and look at the overall sales growth in Hong Kong for the full year, it was up 21%. And that sort of demonstrates that the comparator was quite tough for our Q4 numbers.
Manulife also announcing that you're launching ETF-based mutual funds. Tell us more about that and what investors can expect from that.
Yeah, we want to be the number one choice for customers. And so our drive is to provide customers how they want to invest, what they want to invest. We want to give them as broad an opportunity as possible to invest. And ETFs are a core part of our product offering. And in fact, through John Hancock, the brand that we trade in the US, and through Manulife in Canada, we're able to offer ETFs to give customers that extra choice. When you look at what we offer as a company, we go all along the credit, equity, and infrastructure spectrum. We've got a fully illiquid private credit business that we offer through our Comvest Credit Partners. We've got semi-liquid through CQS based out of London. And then we've got the broad-based Manulife funds that offer public credit with a fantastic track record. So you put all that together on top of really great infrastructure opportunities, and you add the option for customers to invest via ETFs. And we think Manulife is a fantastic option for our customers.
You also announced a new global credit strategy, a couple of announcements yesterday. So tell us more about this strategy.
The global credit strategy, look, there's no real change to global credit for Manulife. We remain very constructive, and we pursue a diversified strategy. We operate in in 14 different countries in Asia. So having people on the ground really gives us that opportunity to assess credit as it happens on the ground, gives us great knowledge locally, and you put all that together, and we remain relatively constructive on the credit space. We do think that the economy will not necessarily struggle too much in 2025, 26, but it's certainly not going to be, a blowout year. And so things like the short-term interest rate, we expect it to remain fairly constant until well into 2027 here in Canada, and that's really reflecting a credit environment that will continue to muddle along, I think.
Is that one of the headwinds, if you want to call it a headwind, that you're anticipating in 2026? I was going to ask you what challenges you see lie ahead for Manulife, and the economy kind of, as you say, like muddling along, maybe could be one of those potential challenges?
Yeah, the great thing about a life insurance company is that a lot of our earnings stream comes from business that we've already written. And so, when you think about some of the challenges, some of the macroeconomic challenges and the geopolitical concerns, that doesn't really impact our earnings per se. But should we see leakage of that into the credit markets, certainly I think the whole financial services sector could see that as a challenge. But I will say, we operate really in the public credit space, so quite high up in the quality spectrum. And in fact, we had a really good credit experience in the fourth quarter. And that's reflective of the fairly benign credit environment, particularly in the public space where we operate.
That was Colin Simpson. He is the chief financial officer at Manulife. Well, Moderna topped Wall Street's fourth quarter revenue and earnings estimates, but the biotech company continues to face sharp year-over-year sales declines as pandemic-era demand fades. So joining us now to break it down is Andrew Tsai, managing director at Jefferies. It's good to have you join us. Thanks for your time.
Thanks for having me. Happy Friday.
Happy Friday to you as well. So I guess, first of all, what stood out to you the most in this latest earnings report from Moderna?
I think for the most part, they did pre-announce last month in January. So the quarter ended up being in line more or less on revenues, but on the expenses side, it did come in ahead of expectations. So as we turn into 2026, again, most things were more or less reiterated expenses, which is one key driving force to getting the stock higher because the company wants to break even by 2028, while revenues are expected to be flattish in 2026. I think those two driving forces could get the stock higher in theory. And that is what investors wanted to pay attention to. But, with this print, the expenses did come in a little bit better than expected. So there was some relief there.
How concerning is it, though, like the FDA's decision not to review the flu vaccine application? How concerning was that to you, do you think, for the company?
I think it's a strange, unusual circumstance. It makes people, including me, wonder whether this is related in part due to politics because, based on what Moderna is saying, they did have two official FDA meetings over the past 2 years that did not indicate the FDA had an issue with how the phase 3 studies were designed. So in terms of your question about concerns, I mean, I would be somewhat concerned around how, at least in the U.S. side, the timing of that could be approved, and what does that mean for outer or medium-term sales to allow Moderna to hit break even. But at the same time, I should also emphasize this is just a U.S. dynamic. Sure, we do model some U.S. flu and flu combo sales on top of that. Those are two separate assets. But I wanted to emphasize that they do have ex-U.S. Regulatory reviews underway right now in the EU, Australia, Canada regions to start, and that seemed to be going well. So it is a stark contrast, and it's said another way, between the U.S. and ex-U.S. so far, but we'll see.
We'll see. I know some Bloomberg intelligence analysts are saying Moderna really needs its cancer treatments to succeed, especially because of what's happening with the flu shots. Do you agree with that? Are the cancer treatments in part like a way forward for this company?
I generally agree that it will be helpful. I think naturally with flu timing being uncertain, same with flu combo, yes, the next, the attention goes to what's next for Moderna, and it would be the INT studies. And yes, this phase 3 melanoma data reading out in 2026 probably should be, I would say, modestly, or it could be significant in revenues. When I say modestly significant, could be $1 billion plus in peak sales. So that will definitely help Moderna's top line, which should be doing about $3 billion this year. So it's definitely helpful. But I would want to know, what else can this specific INT personalized vaccine be able to show in other solid tumors outside of melanoma? Because to me, for instance, renal cell carcinoma or lung cancer, which could have data in 2026, 2027, could be even bigger. So yes, in a sense, this program matters. It's just we need to see the data to be more confident whether this gets through the goal line to have Moderna have more top-line revenue growth.
Yeah, you need more information on that front. In terms of management, does management's 2026 outlook change the story at all for you when it comes to Moderna?
I think it's similar to the messaging from before meaning January and even as far back as November. The current guidance is for revenues this year to grow up to 10%. I think consensus is around flat. But even if they did flat, I think that's good news for Moderna because, like you started off establishing, COVID sales have been declining because there have been decreased vaccination rates. But I'm encouraged, I'm hopeful that at least in the ex-US regions, COVID could grow. It seems like, it's not just COVID vaccinations that can help top line revenue growth. It seems like they have factories, supposedly, I believe in the EU and other regions that could also drive manufacturing revenue to help that top line growth. So I think more or less it's the same expectation that, I'm not surprised basically with the new update today, but it is important to me that COVID or sales overall does not decline significantly this year, which I don't think it should. And then I would add, part of their guidance is for U.S. Sales to actually decline year over year this year. So if for whatever reason, vaccination rates pick up in the U.S., that's good news for the top line revenue.
Okay, so it sounds, just in our last minute here, you sound cautiously optimistic, like you don't think sales will decline anymore, even though that's part of the forecast.
I think sales will be flattish, would be my best guess. Yes, cautiously optimistic would be the right word. Even if it's down 100, 200 million, I think that's fine. To be clear, just to me, it's flattish enough. I just don't want a meaningful drop, which I don't think happens.
Okay, yeah. we will leave it there. Andrew Tsai, Managing Director at Jefferies. Always appreciate your time. Thank you.
Thank you.
Coming up, why Canada and Mexico could see a 6% hit to their GDP if the U.S. pulls out of the CUSMA trade agreement. More on that right after the break. The Department of Homeland Security is now set to lose additional funding with a partial government shutdown looming. Democrats are demanding changes to President Donald Trump's immigration crackdown. ABC's Nicole D'Antonio is in Washington with those details.
This morning, a partial government shutdown looms with additional funding for the Department of Homeland Security set to expire at midnight, and lawmakers now headed out of Washington with no deal in sight. Senate Democrats voting unanimously to block a DHS spending bill after the fatal shootings of Alex Preddy and Renee Good by federal agents in Minneapolis. They want changes to immigration enforcement, which include requiring ICE agents to get warrants signed by a judge before making arrest. And they want to ban agents from wearing face coverings.
What Democrats are demanding is reasonable and it is necessary. None of what we are asking for is extreme for local law enforcement. So why don't those basic standards apply to ICE?
Republicans argue there aren't enough judges to sign so many warrants and that unmasking agents will put their safety at risk. It comes as Border Czar Tom Homan says the massive immigration operation that's been going on for months in Minnesota is coming to an end.
But I'm not going to sit here and say anybody did anything wrong and that, they were, unprofessional. I'm going to say there's some issues here. We fix those issues.
Minnesota Governor Tim Walz is demanding the government, quote, pay for what they broke.
They left us with deep damage, generational trauma. They left us with economic ruin in some cases.
If Homeland Security does shut down, a number of other agencies will be impacted. Airports could see the most immediate impact. TSA agents will be required to work but won't get paid, similar to what happened after the government shut down last fall, which could trigger a wave of sick calls leading to delays.
These same agents who went without a paycheck for 43 days because of the failure of the Democrats to come to the table then. It's exactly what we're seeing now.
And a new poll shows that a majority of Americans, more than 60%, believe President Trump's deployment of immigration agents in U.S. cities has gone too far. Nicole D'Antonio, ABC News, Washington.
A U.S. withdrawal from its trade agreement with Mexico and Canada would deal a severe blow to America's next-door neighbors if it materialized. And for more on that, we are joined by Jimena Zuniga, who is a Latin American geoeconomics analyst with Bloomberg. It's good to have you join us. I wonder, we've heard Donald Trump talk about this before. We're hearing it again. How serious do you think this threat is?
Thank you, Lindsay. Great to be here again. We think the probability of a full USMCA exit is actually very low. We think this is so because of the high level of integration between the three economies, the three North American economies, especially in the vehicle sector, which would make a full exit from the treaty for the U.S. prohibitive. This would just be at a time when the administration of Donald Trump is facing heading to midterm elections. And so it would be very unlikely for him to make such a move that could have very detrimental economic and political implications for his party. So we think this is more like posturing designed to exert pressure on both partners, but especially on Canada, with whom the U.S. has had a thorny relationship since President Trump took office, previously with Prime Minister Justin Trudeau, and more recently also with Mark Carney, especially given his more recent pushback on Trump's policies and style at the Davos conference.
Mm-hmm. Yeah, and as you say, like, we've heard this before, and you say it's unlikely, but if it were to actually happen, what would the outcome be? Because obviously, as you say, this would hurt not only Canada and Mexico, but it would hurt America as well.
Totally. No, definitely that would be a severe blow to the bloc. In particular, for Canada and Mexico, it would be a very serious hit if it did happen. And that is because both countries export more than a large share of their exports to the U.S. And exports to the U.S. represent in both countries more than 10% of these economies' GDP. So they depend largely on U.S. demand. And the USMCA treaty has provided very significant implications, very significant insulation for this economy. So we've heard all the news that when Trump raised fentanyl-related tariffs that imposed on Mexico for 25% and on Canada later raised to 35%. And those are very significant, but they affect only about 10% of exports in Canada and only about 20% of exports in Mexico. And that is because the rest of the export baskets of these economies reaches the U.S. with zero tariffs thanks to the treaty. So an exit of the U.S. from the treaty would be a very severe blow, especially if we assume that exiting means that now Mexico and Canada would face all the additional tariffs that Trump has imposed on other countries since 2025. This would mean that has taken the average tariff rate in the U.S. above 10%, close to 13%. If Mexico and Canada face that, it could lower their exports to the U.S. according to our modeling by about half, and it would be a severe hit of about 6% to their GDP.
Say there is no exit, though, and these renegotiations do happen throughout the summer. Who knows how long it will take? I think we all have a feeling it will take quite some time. Is there one country that could maybe have a better outcome than the other? Because as we know, relations between the U.S. and Mexico have actually been a little stronger lately, but I'm not sure if you could say the same between the U.S. and Canada.
Yes, totally. I think in general, the President Sheinbaum has managed the relationship with Trump in a very pragmatic way. She has struck a very careful balance, maintaining assertiveness and maintaining a lot of her rhetoric in the domestic public, but at the same time quietly accommodating many of the U.S. demands across policy areas, from migration to water to a lot of cooperation in security that for the U.S. Is very important for U.S. policy. And thanks to this, she has avoided the worst of Trump's tariffs in the domain of trade, which is the most critical and most macro-critical domain for the Mexican economy. I think that the relationship, yes, with Canada has been a lot more thorny, and we have seen Trump responding with actual policy to exercises of what he perceives as defiance from other leaders. We saw this in Brazil. We saw this against the BRICS, and Canada may have suffered some of that. But we hope that, and the U.S. authorities do say that relationships with Canada are more challenging, that they are finding more pragmatism in Mexico, but that there is a lot of stake. So we think that even the negotiations are likely going to be tough. Most likely the USMCA will remain in place.
Yeah, and just lastly, with these negotiations, any other risks, even if it does remain in place? What are the main risks, just in our last minute here?
I think that the main risk is that the U.S. will probably quite aggressively and continue to expect and possibly extract more concessions from Canada and Mexico. And the other risk is that even if the USMCA remains in place, as we expect, there's this like 10% of exports in the case of Canada and about 20% of exports in the case of Mexico that are not USMCA, are not covered by the USMCA. And Trump does have the ability to quickly and easily implement or raise those tariffs. And so that is probably going to continue to weigh on the Mexican and Canadian outlook as a factor of uncertainty that may have an impact on investment and growth.
A lot to watch for. That is Jimena Zuniga, Latin American geoeconomics analyst with Bloomberg, joining us live. Appreciate your time. Thanks so much.
Thank you, Lindsay.
And we'll do one last very quick check on the markets here before we wrap up. If we can take a look at North American markets, the TSX is trading up at the moment. We'll continue to watch that throughout the day for you. And that wraps up this edition of The Open. Morning Markets with Roger Peterson is next.